Let me ask you a question most people have never really thought about. Who decides what it costs you to borrow money in America? If you said the Federal Reserve, you're right, technically. But right now, the answer to that question is more complicated than it has been in a very long time. And if you care about your mortgage rate, your credit card rate, your car payment, or the price of groceries, you need to understand what's actually being debated. Because this isn't theoretical. The proposals are documented, the stakes are real, and nobody's explaining them to regular households in plain English, until now. Welcome to Money Monday. I'm Kevin with moneytreeandme, and today we're covering Federal Reserve independence, what it is, why it was designed the way it was, what's being proposed to change it, and what any of this actually means for your family's financial position. Let's get started. The Federal Reserve was purposely structured the way it is. The 14-year terms for board governors, the budget independence from Congress, the rotating structure of the Federal Open Market Committee, which is the group that actually votes on interest rates. None of this happened by accident. It was designed with one goal in mind: to let the people making monetary policy decisions make them based on economic data rather than political calendars. Here's why that matters. Elected officials run on 2 to 4 year cycles, and in those cycles, cheap money is almost always popular. Low interest rates mean easy borrowing, business expansion, consumer spending, and a feeling of economic momentum. Politicians have a structural incentive to want low rates most of the time. But here's the problem with that. Inflation doesn't care about election cycles, and fighting inflation almost always requires doing something unpopular, raising interest rates, slowing borrowing, cooling the economy down enough to stop prices from spiraling. That's an unfavorable short-term fix that produces long-term stability, and it's exactly the kind of decision that an independent central bank can make, but a politically pressured one often can't. The most dramatic example of this in modern American history, Paul Volcker, Fed chair in the early 1980s. He raised the federal funds rate to nearly 20% to break the stagflation of the 1970s. Businesses closed, unemployment spiked. He was publicly despised, and it worked. Inflation came down, the economy stabilized, and the decade that followed was one of the strongest growth periods in United States history. A politically controlled Fed almost certainly doesn't make that call. That's the historical case for independence, so let's talk about what's being proposed to change it. In March of 2024, economists at the Manhattan Institute co-authored a white paper outlining a framework for restructuring the Federal Reserve. This included allowing the president to remove Fed board members and regional bank presidents. It also included bringing the Fed's operating budget under standard congressional appropriations, putting Congress in control of the Fed's funding. They proposed shortening those 14-year governor terms, and they proposed restructuring the FOMC so all 12 regional bank presidents vote at every single meeting, rather than the current rotating system. JP Morgan's analysts reviewed this framework and concluded it would, in their words, materially increase the influence of the president over United States monetary and regulatory policy. Now, I want to be clear about something. These are documented policy proposals. They aren't law. They'd require Congress to amend the Federal Reserve Act. But they exist. They're detailed, and they're being discussed at levels of government that matter. That's worth understanding regardless of where you sit politically, because honestly, the downstream effects on your household budget don't care about your party affiliation. Now let's layer in something called fiscal dominance, because this is the part that makes the Fed's situation even more complicated. Fiscal dominance is what happens when a government's debt load becomes so large that it actually constrains what monetary policy can do. The United States is currently carrying a national debt that exceeds $33 trillion. When that debt is that large, every percentage point increase in interest rates translates to hundreds of billions of dollars in additional annual interest payments on that debt. That widens the deficit, which adds to the debt, which increases the sensitivity to rates. It's a cycle. So, This means the Fed is already operating in a pretty constrained environment, even before any kind of structural changes take place. It just can't raise rates as aggressively as classic inflation-fighting theory might call for, without triggering consequences for the federal balance sheet that, ripple back through the economy. That's really the definition of fiscal dominance, when fiscal conditions limit what monetary policy can actually accomplish. When you add political pressure pushing for lower rates on top of that, you've got a central bank with very little room to maneuver. And a central bank with limited room to maneuver means inflation that's just harder to control. And inflation that's harder to control means, honestly, the purchasing power of your paycheck keeps getting quietly eroded. That's the chain, from Washington to your wallet. Now let's talk about what capital does in this kind of environment, because smart money tends to move before household money does. When monetary policy becomes uncertain, meaning when markets can't confidently predict what the framework for rate decisions will be, large institutional capital tends to get defensive. It moves toward cash, toward short-duration assets, toward hard assets. Gold is historically one of them. Central bank gold purchases have been elevated for the past 2 years, according to World Gold Council data, a pattern that often reflects a preference for stores of value that aren't dependent on any single country's monetary policy. Keep in mind that I'm sharing that as educational context, not as a recommendation. Here's why this matters for working people, even if you don't own a single ounce of gold. When large capital moves to the sidelines, it's capital that isn't funding business expansion. It isn't financing new hires. It isn't backing the kind of productive investment that creates jobs and wages. That contraction in investment is one of the real economic costs of prolonged policy uncertainty. So, what do you actually do with all of this? 3 things, right now. First, audit your variable rate debt. If you're carrying credit card balances, adjustable rate loans, or any debt that reprices with interest rates, map it out this week. Know the numbers. In an environment where rate direction is genuinely uncertain, variable rate exposure is a risk you need to understand clearly and have a plan for. Second, stress test your emergency fund. The guidance is 3 to 6 months of expenses, but I want you to think about where you sit on that range in a higher for longer rate scenario, where borrowing to cover an emergency is more expensive and job markets face more pressure. If you're at the low end of that range, building toward the higher end is a concrete, actionable priority. Third, do a 90-day budget review focused on inflation-sensitive categories: groceries, fuel, utilities, insurance. These are the categories that move fastest when inflationary pressure isn't being contained effectively. If you haven't reviewed your household budget in the last quarter, this week is the week. Here's the thing about moments like this one. You can't control what gets decided at the policy level. You can't vote on Fed structure or debt ceilings or interest rate frameworks, but you can absolutely control your household's resilience. You can reduce your exposure to the things that hurt most when the environment gets unpredictable. And you can do it now, before you need to. Don't panic, but don't sleep either. If this episode gave you something useful, please hit like and subscribe and turn on the Money Monday bell notification so you never miss an episode. Drop your questions in the comments. We read everyone. Until next time, I've been Kevin with moneytreeandme, providing better security and ensuring better lives. Make it a great day.